Hi everyone, good to see you today. So this session is going to be focused on ESG related investment in the hotel sector. We were supposed to have a bit more time, but I know that everybody is starving, so we'll try to make it as entertaining as possible. So my role today is to promote an engaging and informative discussion with our panelists to share insights on what's been happening in the world of ESG related investment in hotels. Obviously, there's been a lot of engagement. There's been a big change, big step change in the last 12 months in engagement from lenders, investors, operators, and also we're starting to see brands coming in. By way of introduction, my name is Rekha. I'm at JLL in the Hotel Capital Markets team and also I'm the chair of the EEA Capital Markets Committee. So if I go from my right, I'll introduce Ben Patton, who joined Federated Hermes Bank in April 2015, and he's the head of real estate debt, and he's responsible for origination, structuring, execution, and ongoing portfolio management of loans for the real estate debt platform. And then we have Alicia Goya, who's ESG manager at AcroInvest. AcroInvest are a hotel owner and operator of more than 750 hotels in 27 countries. And then we have Sabine, who is co-founder and CEO at ProInvest Group and is one of the founding members of the group. And then we have Caroline, who's a member of the executive committee in the hotel real estate company Pandox, with responsibility for the entire ESG area, which involves 158 hotel properties. And finally, last but not least, we've got Chris Penny, who's a senior VP in the European Hotel Asset Management team at Starwood Capital Group. And by way of AUM, they've got about 20 billion AUM in hotels. So, conscious of time, just to kick off the discussion, first question is, as an investor, what are your key considerations when you're assessing new acquisitions? And what are the considerations that can have a material impact on pricing and liquidity in your mind? So who would like to take that question?
Well, if you want to, I can start it off, I guess. So, yeah. Anyway, thanks for having me, by the way. And sorry to be between, your lunch as well, but we'll try to keep it short, I guess. So at ProInvest, I guess we've been on the ESG journey now for quite a while, and I guess that was partly driven by the fact that we do have in-house a development team, we have a day-to-day operating team, as well as an asset management team. And that effectively allowed us to do a number of hotels ground-up development, and we thought to ourselves, we may as well try to implement two things, the best ESG standards possible, and also on the IT side, the biggest fiber cables that you could find at the time, making sure that if everybody uses Netflix, basically the internet is still going to hold up. So for us, the reason to focus on ESG was important because other than doing the right thing by nature, we just believe that going forward, it helps you multiple fronts across the stakeholders. So it helps you from a, as we just heard before, social perspective. The people, staffing, nowadays people do care where they work and they want to be treated, accordingly. They want to know that they are doing the right thing as well by nature, and they obviously, it also helps if you can give them a bit of a career path across various geographies and everything else. So that's something we can facilitate. I think from a banking perspective, and I don't want to take too much here, but obviously banking is all about risks at the end of the day, as we very recently learned, at least the last 2 weeks, I believe. And there again, if you are able to offer lower risk product in the form of a higher ESG compliant hotel, logically from a banking perspective, you're supposed to be lower risk, and as a result of that, we hope at least that you are getting better terms on your credit side. And it will, I guess, in the future come to a point whereby it won't just be a question of better terms, it will be a question of whether you are getting a senior loan or you're not, right? And then obviously all the way to your customer base. I mean, clients that are coming in and kind of staying with us, they are becoming more and more aware of ESG. They are asking us about the carbon footprint. They are very happy to participate in the Green Steel initiatives that I guess at the end of the day exist in ISG as well as across all other, I guess, brand owners currently. So for us, it was really a way of how to differentiate ourselves early on. And then eventually, and this is obviously everybody's looking always at returns when it comes to private equity, right? So how do you find your pricing going forward and knowing that you future-proof your asset and you'll be able to actually get a better value as well from the valuers nowadays who are telling you if you are ESG compliant, effectively there's going to be not necessarily a premium being paid, but at least the value that you have nowadays is going to hold up. While if you're not going to be ESG compliant, you actually are sitting on a vastly diminishing kind of value of an asset potentially, and hence the future proven that is so important. So again, so just to open it up, but these are the various areas for us that are important, and that's why I believe ESG has certainly a role to play within the hospitality space.
Caroline, were you going to say something?
Okay. Yes, we have started to notice first this year, actually, in the selling process, that we have got some questions around the ESG area. Can we show that our properties are ESG and especially taxonomy compliant or not? And this is of course something we are looking at, because if we want to sell, we want to have more buyers of our properties. And this is also a very important cause of why we need to have these green properties. And if we look at when we acquire properties, I'm right now working with a transaction team in how to calculate actually what we get in, and we need to do the transition journey. Because now I just get in the properties and then I need to do the work and get the funds internally to really make them green. So we are actually starting to do it already in the acquisition phase now. And I hope this will be in place end of the year. And here it's quite costly. If you don't have heat pumps, you have gas, or you get in properties with oil, that will be a costly investment. So you need to have capex for that kind.
I think it's worth bearing in mind the speed with which ESG has kind of risen up the agenda as well, because in 2019 we were all aware of it, but I think most people thought hotels are a not dirty asset class. It's not like you're buying a coal mine or something, right? So you did your regular building survey and you would say, oh, you need to replace your boilers or something, but it was on the tick box, but it wasn't a massive driver, right? Then 2020, 2021 was just trying to stay alive. Cash flow's gone to zero, negative. Again, it was rising up the agenda politically, but it was, do we have the cash flows to actually fund any of this? And then you came into 2022, and the EU taxonomy was out, and all of a sudden you did need to start considering, is there an obsolescence risk in any of these investments? But that's all very much on the E side. On the S side, again, 2020, we furloughed all our staff. 2021, they started coming back. 2022, we didn't have enough of them. And so, the staff side of it, and how do you keep those guys happy? How do you actually connect with Generation Z that are working in your bar, your restaurant reception, and make them want to come and work in your hotel and in the industry? Kind of that doesn't factor into the investment decision making, but it's a massive part of the operations and the value creation. So, to come back to your original question, even a year ago, we just valued the cash flows with a little bit of, be aware of the ESG, right? But now it is really getting ingrained into the investment decision making right from up front because of that potential obsolescence risk as that EU taxonomy just rolls out.
Thank you for that. And actually what we're seeing is that these ESG-related checklists for acquisitions, they tend to be quite extensive. They do vary, but they have similar themes. At the end of last year, we conducted a survey. JLL and the EEA conducted a survey asking a load of questions. It's available online if anybody needs access to it. And we asked a question. We said, would you still buy a hotel even if it's not on the net zero carbon pathway for the next 10 years? And 60% of them said they would still buy it. So from an investor perspective, what are the critical components for you? Would you still buy an asset even if it's not on the net zero carbon pathway? What do you consider to be important at this point in time? Sorry, tricky question, I know.
Well, hopefully somebody here can tell me what a really credible net zero pathway is. we kind of had the question earlier today, does that have to include your scope 3 emissions for everyone
So
that's coming to your hotel?
your operational, yeah.
So I understand, right? But I think, does the industry really understand what is a credible pathway to net zero? Because again, it's part of the development of the whole economy, because if your energy coming from the grid's being generated by a gas power station, again, you're offsetting, but is that really offsetting to the point we had earlier? So I'm a little bit of a cynic when it comes to stuff like this, but somebody says they have a pathway for their hotel being net zero in 10 years. I kind of think that might not be entirely credible without spending money on offsets that aren't 100% visible as to the benefit that they're having. So, we still buy assets that don't have net zero plans.
And Ben, just turning to the lender perspective, what are you seeing in your space? What's important for you when you're considering your lending criteria?
Yeah, sure. So I think if you'd asked me that question 5 years ago, there'd have been very little talk in the lending market about ESG, probably similar to what we were seeing in the equity markets as well. And probably up until about a year ago, the focus was, I'd say, entirely on EPCs. But the market's really moved on a lot now. I think lenders really want to get to know the full energy use of your assets and the full footprint of your hotels. So what we typically, I think, look for is a full suite of data around energy use, waste management, water use. And I think the industry is starting to adopt the CREM model, which I'm sure some of you have heard or seen or have even looked at, as the kind of industry benchmark as to what a hotel looks like in terms of a stranded or a non-stranded asset. How it impacts your lending decisions does still depend largely on where your capital comes from as a lender. If you're in a banking environment or if you're managing institutional or pension scheme capital, you're going to be very focused on lending against those hotels where there isn't a stranded scenario, certainly within your loan term and probably within a good period after that, so you take away the refinancing risk. But there's also a huge part of the banking market is funded by the alternative lending space, the debt funds, and they're very keen to look at the transitional element as well. There's some real value in funding transitional hotels. So you could have scenarios where you have a hotel that is potentially stranded during your loan term, but with investment can become compliant. And I think that's where the kind of focus is at the moment with the lending space. Data is key. If you haven't got any data, I'd say you do run the risk of having very limited options. But the other thing I would say is hotels, as a lender looking across all of the commercial real estate asset classes, hotels actually is probably the best placed. Apart from leased hotels, arguably you have access to all the data yourselves, whereas if you look at offices, retail parks, logistics, you're so reliant on the tenants to get a lot of that energy use. Actually, hotels is a really well-placed sector amongst the commercial real estate lending market to really progress forward quickly.
That's really interesting, and particularly the fact that you're using the carbon risk real estate monitor as the framework to see if the hotel or the asset that you're lending against is on the pathway during your loan term. And, obviously hotels are very operationally energy intensive. Are you finding that some of these are on the pathway once CapEx has been considered? From a hotel perspective, how does it compare to other sectors?
I think we're seeing a real mix, because obviously the CREM model takes into account the geographic location that you are as well. So we've got quite a big European hotel portfolio in terms of what we lend against. The hotels that we lend against in Portugal, where you've got fantastic opportunities to use lots of land and do lots of PV panels and generate a lot of renewable energy yourselves. And with the way that the grid over there is a lot more decarbonised than it is in the UK, those assets look incredibly compliant for 20, 25 years. There's assets in the UK which unfortunately look really challenged, even though you're probably doing the best you possibly can with the physical element of the building. So it does really mix across the asset classes. I think the one thing that that's really important, I think, is sharing how you can improve those assets. I mean, PV panels and things like that go some way, but really the industry, I think, really should and is doing a good job in sharing best practices in how the operational use of the hotels could become more efficient, because that's where there's going to be some really big wins, I think, going forward.
And these, the borrowers who are getting these sustainability-linked loans, what do those groups look like? Are they more institutional, or are you seeing other groups as well, owner-operators and PE?
Yeah, a whole range. Again, I think the sustainability-linked loan market's probably moved on quite a lot from what you and I would probably typically think of as an SLL, which is essentially a margin reduction to improve the efficiency in some way. And they were fantastic when they were kind of launched 5 or 6 years ago, and I think they were a real enabler in the debt space to get people thinking about the challenges that we're all facing. I think what we're seeing now is that actually sustainability is pretty much embedded in every lender's decision-making process. So what you're probably seeing is a polarization of where lenders are focusing. Those lenders with bank capital or institutional capital are very much looking for compliant assets today. And those lenders where, which is, I guess, akin to an Article 9 type investment, those lenders that have more varied sources of capital are probably looking for more Article 8 type investments where, you can really, with some input, you can really develop the asset and make it compliant over time.
So the Sustainable Fund Disclosure Regulation says basically how sustainable your funds are. And Article 9 is the most sustainable. And I think you guys have just launched a fund, haven't you? A credit fund, which is Article 9.
Ours is Article 8 still. Article 9 is very, very difficult because you have to have from a lender's point of view, there's not only the underlying requirement to link it to a specific target, which is fantastic, and that's probably the easy bit. The challenging part for the debt markets is you've got to demonstrate that your capital is delivering that change. And I think realistically, you can make an easy argument that an owner of a hotel could acquire the asset in all equity, and how much is the debt really impacting there. It's slightly different when you look at development. So development of new hotels, that is more akin to an Article 9 investment because you're doing a development loan. But there's a huge amount of appetite in the Article 8 space and a huge amount of investor appetite. And hotels is a fantastic sector to focus on because you have that data that you can readily disclose. So it makes it a lot easier for lenders like us when we're fundraising with investors and to demonstrate to investors that you genuinely have a good Article 8 investment that you can look to.
Can I just add one thing? Because I think the lender and the bank's perspective is super important to drive change in executive management groups because money talks. The only thing I hope is that the discount will be bigger because if we are talking more openly around it, it's 0 to 2.5 basis points. When you're talking about sustainability-linked loans, are you very good in negotiating? Maybe you get 5 basis points. And we are talking about real estate, that's nothing. And our CEO is laughing because that's like small money in this industry. Are you talking about bonds? It can be 10 basis points. So I hope that really there will be a development here to push us further, and the executive management group in different companies.
But I hope that this is what I tried to say before. I think it will eventuate into a binary decision making, right? I think if it's a non-compliant ESG asset, it doesn't matter actually if it's hotel or non-hotel. I think the majority of the boards will probably decide to no longer have exposure to it, right? I mean, as we know, right, in Germany now in particular, right, you can only have so much of non-ESG compliant assets in your portfolio, be it on the equity side, be it on the debt side. So I'm very much with you. I would also love to see the fees coming down, obviously, in particular as the interest rate. but I do believe over a 5-year horizon, definitely, I think definitely there is going to be lots of benefits from being ESG compliant, right? Because it doesn't work differently.
I think, sorry, just one point to maybe wrap up the pricing piece. I think what you probably will find is on super sustainable product, whether it's hotels, offices, or logistics, across the lending space, there's probably more appetite now than there ever has been to lend into that sector. So actually margins on some of the things that we see across Europe are less than they were pre-COVID. Of course, the underlying base rate has increased, so it still makes the overall financing more expensive. But typically, if you're at that super end, because there's just a limited amount of that product at the moment, and hopefully as more comes through, the capital will flow to that part of the market and you'll see that pricing benefit remain for a good period of time.
And moving on, if we're looking at science-based targets, so thousands of companies have signed up, and I think that Accor Invest may be able to speak a bit around the actions they're taking in this space, and I think also Pandox.
Okay, so I can start. Yes, at Accor Invest, we committed to setting science-based targets. It's something that is not easy because the first step is to commit, which we've done. Second is to develop targets, which we've done, and it's easy as well, I would say, because we just have to keep into the 1.5 trajectory and stay in the reduction 4.2. So this is easy, but the challenging part is how do we reach these targets? And before submitting the targets, we need to have a robust plan in place that we prove that we can reach them. And to develop this plan, we launched last year a really comprehensive project with energy audits in a lot of our properties. So we have 750 properties across 27 countries. So different segments, different brands. And we needed to have the specifics of each of the hotels. And as the first conclusion, we arrived to estimate what is the capex needed to reach our targets, what will be the savings, because of course we will have savings and reduce energy cost, which today is really important. But the first conclusion was, yes, we need to invest, but we need to invest in our people. We are employer of 26,000 people all over the world, and it's our best asset. It has been mentioned in the conversation, but operational procedures need to evolve, need to change. So today we need to invest in people, we need to upskill all the teams, and we need to train them to make sure that they're ready to face this transition that we are looking for. So our plan is based on 3 steps. First step is no capex, meaning we invest in people, we raise awareness, we train. And I join here, Alice, it's not enough to train people. We really need to measure the outcomes of all the things that we do. Second is low capex actions, such as retrocommissioning installation, which is something that could be done in a quite easy way. And third step will be high capex investments. This means that we will be able to anticipate the capex that we need to expend and to plan it in advance and look for financial mechanisms to finance our transition. Also, of course, we need to buy green energy. This is something that is like transversal to our plan, but the extra cost that we will pay for this green energy will be directly absorbed by the savings that we are doing. And I don't really like to speak about compensation, and it has been already discussed, but this will be the very last step of our plan. Once we do the maximum that we can, we will start thinking about compensation and offsetting.
Yes, and we have sent in our commitment and also our targets, and the targets will be reviewed by SBTi in June, and we are quite comfortable with these targets since we have done the work together with Swedish Environmental Institute. And for us, it's a natural development to set the science-based targets, because if you do that, you are on the right track. And since we have existing properties, the taxonomy, which I really love, but it needs some maybe subcategories because operation is not included. So today the operations are just pointing the fingers and saying, do the work by yourself. We don't need to help you. So I think science-based targets are still making us take the necessary steps that we need to take. For example, phasing out gas is what we need to do in the scope 1 and 2 operations with 45%. We need to work much more with energy efficiency, like building management system to steer and have sub-meters. When we're talking about scope 3, it's minus 25% that we need to decrease. And here we need to implement green agreements with our tenants and also work with our materials when we construct, renovate, etc. So it will be a very interesting pathway for us onwards.
I think that's great progress, and it's a good example for the industry on how to really just get going. But the question is, what are the biggest challenges that you're facing? Because with such a large real estate portfolio Europe-wide with differing levels of regulation, there's cash constraints, debt is through the roof. There's investor pressure. You may not necessarily be able to immediately draw down more capital, so you may need to be selective. What are you finding in that space in terms of challenges?
Yeah. So in our case, as I said before, high capex measures will be the third part of our plan. So this will allow us to really anticipate the capex that we will need to put in place and to look for the right mechanisms to finance them. We really believe that we need to first concentrate in the operational changes. As it said, VMS is important. I have a really good example. We have a really good building in which we have a really good BMS. It's BREEAM very good. But when we did the energy audit, it was not performing as it should. And it's because it was not being operated as it should be operated. So it's not only investing once in the building, it's not only giving the right tools, it's making employees learn how to use these tools, even when the staff is, turnover in staff is really high. So we need to keep focus on this and then plan capex high measure investments in the long term, looking for sustainable finance mechanisms.
I would also say that it's super important to have like 5-10 years plans now for capex, so the firm knows when to take the different capex investments, but also to work more jointly with our operators, I would say. Because if we need to do BREEAM very good, we need to get access to the properties, we need to have help to produce the documents, and that they are also working with these tasks, the manuals afterwards when we leave. Also about having these green agreements in place, that they really understand that we can have like a mechanism for how to benefit both parties. But today I think it's a quite immature market still, because even if we say we take the investments, but we need to do something on the rent increase, there is like no one on the other side. They have already left.
And maybe just one word as well from our own experience, just to add, because it's great, obviously, if you have a BMS system, but let's be honest, there's a whole world of hotels out there that are older than 20 years that don't have the latest Schneider BMS inside. So the big question is how we're dealing with this. And I think it's really fascinating. If you just take a step aside, so I was in Mippen 2 weeks ago, and actually met up with a quite young company, and what they're doing is they're helping to put in as an afterthought, basically, small sensors across the estate, across the hotel, at a fraction of the cost that your BMS or Schneider BMS system would cost you. So now again, at least what that allows you is to get the data and at least to know what the problems are. What it doesn't obviously allow you is to be reactive, what the BMS system. But what I'm saying is things that about 2 years ago would have been impossible to do. There's a lot of new tech out there, and it's just everybody should really, whenever you go to these conferences, spend time with the venture companies, right? Spend a bit of time there. They're coming out with fascinating solutions that really can help us all to even make the older assets that effectively represent the majority of hotels, quite often, at least in a number of countries, right? Particularly in Europe, how to get them up to specs, even if you do not have a built-in BMS system, and even if the actual capex would not, because of the performance of the hotel or whatever, it wouldn't allow you to put it in place. But there are other alternative solutions out there, and so that's what we're using as well whenever we convert some of the assets.
Maybe one last one, Rebecca.
Sure. Well, the collaboration and innovation part is very, very key, cross-sector as well. So in Europe, more than 40% of the rooms are branded. What about the role of the brands? Because we've seen all of the major brands make major commitments. To what degree are we seeing that level of collaboration with asset owners? Or what more do you think needs to be done?
Well, this does tie into the last point, that your hotel is ultimately operated by an operator with a brand behind it, and you need the buy-in of both of those guys to get any return on any of your investments, right? If you have the most sustainable, carbon-neutral hotel, but it can't be marketed as such, you're not going to get a return on that capital investment. So I think the brands are still working through what it means for their estate, and they're obviously worried about obsolescence in some bits of it. There's no silver bullet here, right? It's a complicated issue. But I think the brands need to do a bit more in being able to get customers to understand why they should pay a premium for assets that are more sustainable and on a pathway than ones that aren't on that journey.
I think for them, the skill perspective, I think is super important when we talk backhouse, because today, often the people that should manage these nice BMS systems that we want to put in or we want to track data, they don't even know how to handle it. Maybe it's someone from the receptionist that ended up like a guy going around in the building. And also the salary issues here, because we are really pushing this in our own operation. It's only 20 hotels, but we continuously need to educate. And then they are maybe quitting, we need to start again. So it's an ongoing education all the time, because it's becoming more technical, and to have smart properties, you need to have the right people backhouse.
So from our experience so far, as we're working with various brand owners, right? I mean, it really, now across more than 6,000 rooms, I think we at some stage just decided to try to create our own brand, so to speak, right? So to effectively as well reflect the fact that we're trying to be holistic, try to take the development phase and the operating phase and the asset management into consideration. So it's called One Earth Countless Experiences. And what it really does is it's trying to, I mean, we proactively, not actively, proactively with the brand owners are trying to, come up with new ideas, be the first one to implement certain initiatives. And I think that's the only way, because as you rightly point out, there is obviously a bit of a conflict of interest. I mean, which brand owner is going to let go of, 30% of their existing, portfolio because they're not up to, Article 8, right? It's not going to happen tomorrow. But I think it's a step-by-step process, and I think if you happen to be the owner's representative and the operator, which we are, you can achieve quite a bit because you can also incentivize the operations accordingly, right? So in our case, we have annual ESG audits that are being run, and our GM, a percentage of that bonus is a reflection of the outcome of those ESG audits. So there are ways of how to get there, but it needs a lot of proactive management because of otherwise there are conflicts of interest out there.
Just to not be too negative on the brands, I think it's the opportunity. It's the opportunity as well, right? It's not. That's why we want them to do more, because customers will pay more to stay in a hotel that is aligned with their social values.
Have you seen that happen?
Yeah. So the One Hotels. So the CEO of SH Group is also the CEO of Startup Capital, but we're not the same business. But we own some of those hotels, and the way that we see those perform is better than we expected, and they're outperforming their comp sets because people feel a connection with that brand and will pay up for that. And so there's not just, there's a massive opportunity there for kind of all hotel owners and asset owners and the brands as well, if they can connect with their customers.
This is very, very interesting to hear, because this topic comes up a lot, Are we going to get a premium for hotels? Because in offices, corporate-led, occupier-led, they have their own targets and they're willing to pay more rent. The institutions are paying sharper yields. But on the operational side of things in hotels, you can argue that your OPEX will be lower. The top line is a bit more challenging, particularly in this environment. So it's good to hear that we are starting to see that, particularly in certain segments.
Great. Thank you very much. That's brilliant. Thank you all very much. That's terrific.